you've heard about Silicon Valley Bank being taken over by FDIC regulators on Friday. Signature biting the bullet, regulators determining that the bank was not sound enough and posed a systemic risk. So taking SVB off the table, John and I fielding tons and tons of questions from followers and investors. What's next? Is there another shoe to drop? Are there other banks that might fail? And are there opportunities that are being presented with even major money center banks, big so-called wirehouse banks, taking it on the chin as investors try to determine what to make of this whole situation? So, John, thank you for having me. And as we've been doing since the news broke, John and I have been tirelessly, as he mentioned, on Twitter Spaces, podcasts, all various forms of medium where we shared the airwaves with the likes of Bill Ackman and Mark Cuban, and just some really remarkable conversations throughout this crisis, and hopefully crisis averted.
Right. And obviously, for those of you who don't know more about Mark's background, folks, he was both a trader and a lawyer, a hedge fund lawyer, a venture investor. So there's really not a lot of people that have as much cred as he has in the space about what just happened. And, you know, you've got a massive bank, 16th biggest bank in the US, fails. It failed because they had very poor risk parameters. And Mark, maybe if you tell people just a little bit about that, as far as when a bank gets capital, folks, it would love to just lend it out and make 1% or 2 or 5 between what they're paying depositors and people they're lending money to. But banks also buy paper, various government paper, 1 year, 3 year, 5 year, 10 year, blah, blah, blah. What happened in this case with Silicon Valley Bank?
Well, you know, John, this is sort of a classic asset liability duration mismatch, right? Yeah. So, you know, we think the logical thing is more deposits are good for banks. And that is generally speaking true. But the origin of what happened with Silicon Valley Bank has to, like most wonderful things of the past few years, go back to the great COVID-19 pandemic. And what am I talking about? All of that helicopter stimmy money caused deposits. Thankfully, a lot of people saved that money, and corporations as well, put that money in the bank at a rate that was unprecedented in 40 plus years of data that we saw increase in bank deposits starting in 2020. But the banks are not able to underwrite and loan that money out as quickly as it comes in. It's just fundamentally not possible unless you do some of the haphazard, easy money, no doc lending stuff that got us into trouble during the last financial crisis. And of course, there were a lot of parameters put around that to prevent that from happening. So banks like SVB, is what John said, they loaded up on paper, primarily treasuries, but also MBS, mortgage-backed securities. And but you got to get that right? And as interest rates change, and another thing people ask us all the time, rising rates are generally a good thing for banks, right? When we were seeing the pivot and from risk on to risk off assets, and the rising rate chain start to flow, we talked a lot about having a positive impact on banks, because that's generally the case, but not the case with Silicon Valley Bank, right? So as interest rates rise, bonds tend to decline in price. And so if banks are holding large portfolios of these bonds, like SVB and others, they suffer unrealized losses on those assets. But of course, John, when you have the kind of concern run on the bank type situation with Silicon Valley, that's not a good thing, because that snowball starts to go downhill.
Yeah. And like you said, the mismatch in duration means that they have a bunch of 1 year, 3 year, 5 year, 10-year paper on their books. They don't have to take the loss on that until they sell, because they could hold it to maturity. But instead, of course, they started selling before they raised capital, and all of a sudden, you know, their balance sheet went from this to this, you know, that fast. And that, you know, that's why when Mark and I say, folks, that depositors should be protected, because it's their money in the bank. They didn't make stupid investments. They may have been stupid or they may have had a gun to their head from Silicon Valley Bank to only deal with them, or they won't raise money for you and so forth. But this was not risky trading. It was not ninja loans and all that kind of stuff.
Right.
It was that mismatch in duration. That's what took them down. And once the run started at the other banks, First Republic, Signature Bank, Zions, all of those, well, they may not have a mismatch in maturity, but nobody has enough billions of dollars to give to the depositors that want to withdraw that money as quickly as possible. So we ended up with this horrible bank run that got solved somewhat, I guess, yesterday, Mark, but there might be more to come.
Yeah. Well, I mean, because, it kicks off a vicious cycle, John, right? Because banks at a time when they need to potentially shore up their balance sheets are seeing precipitous drops in the prices of in their stock, right? Which, of course, is something that we're going to talk about to try to address those questions of, is this, should I be starting to look at buying at some of these stocks? And we're going to talk about that. And John, one of the things that I've been hearing a lot about in terms of trying to determine what banks are most likely to survive this and maybe are a good buying opportunity is their correlation to bonds. Some of the research that I did over the past couple of days, 3 of the 10 bank stocks that had the strongest correlation to the bond market over the past year are the 3 that actually were shut down, right? If talking about Silvergate, SVB, and Signature. What does that tell us as we see 2-year yields declining?
Yeah, well, it tells us that the rich get richer as usual, because Jamie's going to get something. Other of the too big to fail banks like Citi and Bank America are going to get pieces of this. This is a windfall to them, but it's clearly a huge loss for regular Joes and Janes, as well as it's not just Silicon Valley bigwigs like Mark Andreessen of Andreessen Horowitz or any of those. This is beyond that. And bank runs end up affecting all of us with car loans, defaults, credit cards spiraling, people borrowing basically with their credit cards because they have to.
Want more from Market Rebellion? Don't forget to like and subscribe, and learn more about options trading at marketrebellion.com.